You're listening to Interchain FM, the Cosmos radio station. If you're seeking alpha in the cosmos, look no further. I'm your host, Django Unchained. I'm here with Dan and Davide, two contributors of the Mars Protocol. And I've had Larry and Jose from Mars come in the past. So be sure to listen to those interviews if you want a primer. We also covered Asteroid. And today we're lucky to have these two here talking about the latest updates about Mars. Mars Hub is being deprecated and it's going under some migration work. So glad to have you two here. Do you want to start with your intros so people can understand your backgrounds?
Background, I'm a developer, have been a developer for a long time now, coming up 15 years or so. I was one of the original contributors on Mars Protocol back in 21 on the Terra blockchain when we first started developing that. And yeah, I'm coming up 3 years, actually over 3 years now, contributing to the protocol.
Background, TradFi on Wall Street. Like I worked at Bridgewater Associates for like 5 years in as a financial engineer, just product thereafter in Silicon Valley, always in fintech. And now I'm a contributor on the product side of things. I've been doing that for about, coming like say almost 2 years.
Would either of you like to share the story about what was going on in the war room when Terra collapsed?
It would have to be Day because I wasn't part of Mars at that point. So
yeah, I mean, it was an interesting time because I think a lot of us had our personal portfolios highly intertwined with that, right? So you both, seeing that destroyed, but and then like the main consideration was that the blockchain wasn't making blocks at the time, or they were very slow, and trying to get transactions through were taking like up to 30 minutes. And for a lending protocol, our main concern was liquidations there, right? So we were just trying to monitor that, push Oracle updates on chain and push liquidations through. And we did escape without incurring any bad debt, or maybe we incurred like $20 worth of bad debt or something through that. So that was a really good thing to come out of. But it was very interesting times. That I remember the dev that was kind of like the lead on the liquidation bot side of things. He was like in some remote island. He was meant to be on holiday at that point, and he was like wiring in with really crappy internet, trying to help things out. And yeah, just absolute chaos, right? And I think a lot of us were not thinking it was like over or anything. So we were focusing more on the protocol and just making sure that remained solvent, which was a good thing. But a lot of us got pretty wrecked in doing so because we were just like, leave the personal portfolio. I even personally, like at the time, there's a lot of people like shorting Luna through Mars, and there wasn't enough liquidity available to like withdraw Luna at the time. So I remember I actually put some of my own Luna into the protocol just to help liquidations go through. Because when you liquidate someone, you need to like claim the collateral as part of it, right? And there's no Luna to claim. It was all borrowed out. And I remember just depositing a chunk of my own Luna and it just kind of getting gobbled up. And I'm like, oh, shit. So yeah, definitely interesting times, but it was really good that we came out of that as a protocol without incurring like bad debt, essentially.
Yeah. Wow. You were the equivalent to the band playing the violin and the music on the Titanic as it was going down.
Yeah.
Good for you. I mean, very valiant. I mean, sucks for you, but you know what I mean. Fast forward 3 years, we are in present day 2024, still in the midst of a bull market. What's going on with Mars? You guys are deprecating the Mars Hub. Was that what I'm hearing?
I can talk a bit on that too, right? So like after the Terra collapse, we sat back and we really tried to think hard about like what the next best move was for Mars, right? Because we had a great team, we still had funding, and we had a desire to really like build out like and advance the kind of lending primitives and blockchain. So we took a bit of time as a team to decide where we want to go, and we were considering everything like Solana, EVM, etc. At the end of the day, we were still really bullish on Cosmos and the tech, and we also had great skill set in that area, right? Like all of our engineers were specialized in like Cosmosm and Cosmos SDK. So that made sense to us. We were still bullish Cosmos. We had the skill set. So instead we looked at, rather than focusing on like a single chain and deploying there, kind of joining more of like the Cosmos OG vision, I guess you could call it, where everything's going to be an app chain, and we wanted to be part of that. And with the state of IBC still today, even, but especially back then, being like a lending protocol, you're really a like primitive where you need other protocols to be able to like build on top of you in a composable way. So for us, it didn't really make sense at the time to have our own app chain where all the activity was built there. Instead, we wanted to be able to like place outposts wherever there was good liquidity and demand for leverage, and that would enable like the composability of DeFi that you saw like on Ethereum, right? That created this whole DeFi buzz. So that was kind of the goal. But then we needed some sort of way to coordinate all these potential outposts. And back then we were thinking, you know, like we're going to rebound from Terra. There's going to be billions of TVL across many Cosmos chains. So let's be wherever there is liquidity, and let's have Mars Hub as a sort of central place to coordinate essentially governance and like protocol revenue coming in, etc. That was kind of the vision, and that hasn't so much played out, unfortunately for Cosmos, right? TVL is still very lacking. So that assumption we had hasn't played out, and we've kind of decided to pivot and adjust based on that. And what we see now is like there isn't really enough TVL in Cosmos for a pure money market to make a lot of sense, and that like a money market needs in the billions of TVL to essentially be making a good amount of revenue for the protocol to make sense, because money markets are very expensive to run. Like they're very sophisticated. What we sort of sat back and decided is rather than being a pure money market and just focusing on like advancing that sole primitive, you know, to do things like what you see like Morpho Blue and Euler Finance and that, you know, they're all really like going down that pure lending protocol and advancing that primitive, but it relies on kind of not leeching, but like being part of the chain and its greater TVL. And when you don't have that on offer in Cosmos, what can you do, right? So what our thinking was is rather than us relying on the chains bringing in the users and we're just using that TVL as like a primitive on that chain, we want to be an app that actually like brings users to a chain. So how can we do that? How can we build this experience where we're actually bringing users into Cosmos? And that's kind of where we've pivoted now to actually really like doubling down on specifically Neutron right now, and really integrating at the chain level there, and having them kind of be able to look after all of the chain level side, and us really just focus on the app and building the best app we can build to actually attract users into Cosmos. I don't know, Davide, if you want to add to that.
Right, there's really two ways of looking at this, right? One is, okay, am I being this sort of like this money market, which, you know, like as you mentioned, like you just go on a chain and you're offering that service, right, of that chain, which is kind of like simple leverage around the chain, right? Again, that makes sense if you manage billions of dollars, right? So our original hypothesis was, okay, let's just be this kind of like money market that's spread across Cosmos, and Mars Hub being the orchestration layer of the protocol revenue, right? Ultimately, when we recouped together, and then we made that decision to stay on Cosmos, and then like our vision was essentially to essentially build a deep product, right? Our vision essentially changed from just like this kind of like money market to be more like the best place to trade on leverage in crypto, right? In DeFi and in crypto, right? And so for you to do that, you really have to build a deep product, right? And when you extend yourself across different chains, it becomes very difficult because each additional chain is additional maintenance, right? And for you to build deep features and then really achieve your vision, which was that, right, become the best place to trade on leverage, you're not going to be able to do that in a good way, right? With a reasonable amount of resources. So like that's why we decided to go deep, and as you mentioned, like just be a great product and then attract users that way, versus just spread out and be this primitive that is complex to run, is expensive, is very risky, and doesn't make sense if the chain you're on doesn't have enough leverage. Sorry, doesn't have enough TVL.
The last time I checked with Mars Protocol, you were basically multi-chain deployed on Osmosis and Neutron. Are those being deprecated, or are you still going to continue to maintain them but double down on the TVL that's on Neutron?
So we're still 100% committed to both chains, Osmosis and Neutron. But I think the difference is that between those two chains is that we intend to go deep on our product first and execute essentially our like full vision of the product first on Neutron. In a way, like, there can, in the same way that there are many centralized exchanges that are successful, you can have multiple DeFi hubs that are successful, right? So Osmosis clearly has the highest TVL, is the highest usage. It's a great place to be, right? But I think like what Dan was mentioning was our first iteration of the full vision of the product. We intend to do that essentially initially on Neutron.
Why is Neutron the top contender if it has less TVL than Osmosis at present?
Yeah, it's a good question. It's not just about TVL. It's about essentially also like what Dan was mentioning is like the way when we had to make a decision initially, where do we want to like go deep? Ultimately, the decision was around who can we partner with that would enable us to essentially just build a product and not focus on the chain, and would kind of like in a way like help us achieve that goal in the fastest possible way, right? So the thing with Osmosis is that they're brilliant guys, like Sunny and Dev are brilliant guys, and they're like top OGs in Cosmos, and great innovators. But the thing is they have so many things they're building, and a lot of them are great. But for us, really what it boiled down to was where can we like when Neutron is really building. It's like it's kind of like positioning itself to be a place where you can kind of like you go in as a product, you would build there and it would support you and make sure that you would be successful in the fastest way possible, right? And so we kind of like it was more like a decision in that direction than versus kind of like what is the place with the highest TVL, because clearly Osmosis is the place with the highest TVL. I don't know, Dane, if you want to, it's more like also tech
there as well. I think Osmosis is definitely going to continue to be successful within Cosmos and hopefully take some share from other chains there. I think the guys are really going through, Osmosis is going through a period of like kind of discovering what's next, right? Like they were the leading DEX. There was talk about like a perps platform, integrating Bitcoin. There's a lot of this stuff going on, and to build on it, it's almost like a little overwhelming. It's like, this is awesome, but there's a lot changing and there's a lot happening, and the roadmap isn't super clear to us right now, but like we're there, and it is the most successful Cosmos chain, and we continue to support it and grow with it. However that ends up happening, like right now, I'm not 100% clear on like what Osmosis is going to look like in a year. And I think as someone building on it, that is probably the downside of Osmosis, even though I think it is going to be successful. I think from a like community point of view, Osmosis is really about Osmosis and the DEX and whatever develops out of that. And Mars needs to just be able to like adapt to whatever changes come there, right? And we will continue to do that as Osmosis adapts. And contrasting that, Neutron has been very clear that they want to be the replacement of Terra in the regard of like, this is the best place to come as a smart contract protocol and deploy here. We're going to be like a pretty stable base to build on, but we will also enable a lot of sort of like integration into chain level functionality that you can't do anywhere else, right? So Neutron's been more clear there on like, this is our roadmap. We're here purely to really support the apps that are building on it. We're not building our own thing. And obviously you can be like, well, there's like duality and stuff. But even with that, they've been very talking about how they want that to be very synergistic, and they don't want duality to even compete with other apps coming onto that. They just want to focus on purely building infrastructure that enables other apps to come and build whatever they want there. And I think that's the difference. I don't know which one's going to win, or there doesn't even need to be a winner, right? Like they're just going to end up quite different. I think Neutron is going to be a number of different apps building out a Neutron ecosystem. And if that works, then that's, I think, what the winning formula will be. And Neutron is behind the scenes, just like making the chain the best chain it could be for doing that. Whereas I think Osmosis is the one that's driving that forward there, doing that innovation. And if apps want to come and kind of like build on top of or on the side of what Osmosis is offering, then like, great, you can do that. But it's kind of like two very different tracks to take it.
That makes sense. Tell me about your V2 with Astroport LP integration. What is that?
Right now in Neutron, we only have V1. V1 essentially is the first iteration of Mars, which is basically just the money market functionality, right? There's traditional like lending and borrowing, right? V2, which was what we launched the original Osmosis, is is really the kind of like the basis of kind of like the ultimate vision of our product, which is kind of like our credit accounts, which is like this new DeFi primitive that brings this great capital efficiency in DeFi, similar to what you had on centralized exchanges. So the sub accounts of centralized exchanges, right? Now you have it as a primitive on DeFi, right? And what that means is that, like, what does that actually mean? It just means that you can actually have in this credit account, which is an NFT and it's composable, you can actually hold any asset that's on chain, any token on chain, may it be like just a token, or may it be essentially an LP, as long as it's available on chain. It can act as collateral in your account, right? So that gives you great capital efficiency, which means you can actually hold, I don't know, like WBTC as collateral, but you can also hold, like we used to do on Osmosis, you can also hold like vault shares, right? Like the Apollo vault shares as collateral, right? And they're all acting towards your account collateral. So what we're doing this Astroport LP integration is like, we're actually, for the first time, we're going to have direct integration of the LPs of the DEX, right? So you can actually from Mars, you can actually take on an Astroport position, maybe a PCL position, on a pool that you're interested in, and hold that as collateral on Mars. So you can directly on Mars in the account, right? Which allows you to do like leverage directly from there. And yeah, so it's just like a tighter integration than what we currently have on Osmosis. And it's very exciting because you can do all sorts of different strategies with this, right? You can do delta neutral strategies where you're kind of like hedging out. If you're a little bit more sophisticated, kind of like LPer, and you want to reduce volatility, you can kind of like with Mars, you can just like deposit into, like, for example, into like an Astroport LP, like for example, I don't know, WBTC, USDC pair, and you can kind of like borrow WBTC and kind of like sell it for leverage, and that kind of like hedges out a little bit the volatility. I mean, quite a bit, the volatility of BTC. You're close to delta neutral, right? So that's just like a basic strategy, but it's exciting because, it's just great. It's just an additional great capital efficiency that you start seeing in Cosmos that's, didn't exist before.
Can you define PCL?
It's passive concentrated liquidity.
Yeah, I mean, I'm definitely not a AMM expert. I'm more on the lending side of things, but yeah, if we compare like Osmosis's concentrated liquidity versus Astroport's passive concentrated liquidity, Osmosis concentrated liquidity is, users or perhaps bots going in and like actively setting the range that they want their liquidity to sit in that pool. Whereas passive is like there's some sort of algorithm and they're doing it, right? So Astroport's one was largely based off curves, Curve V2. They're one where you have an algorithm that is essentially looking at like an Oracle price, which my understanding is roughly it's like a EMA that's tracked internally in the pool, and it kind of just adjusts the liquidity concentration, similar to a stable swap pool would do, but it's like a moving target, right? So like stable swaps, you tend to have like a fixed position within like the AMM curve where it concentrates liquidity around. PCL was similar, but like that fixed position is actually like moving based on like a EMA.
Yeah. So in a nutshell, basically the advantage of active concentrated liquidity, like the one in Osmosis, and passive concentrated liquidity is that you really just need less liquidity as an LPer. You deposit less liquidity, which means potentially your fees are higher, right? That's ultimately why you do this. You need just like less liquidity to far higher fees, and ultimately it should translate in also better trading fees for the trader, which is ultimately the user, right? That you're optimizing for.
Yeah, and I think there are pros and cons of both, right? Like with Osmosis, you can set much tighter ranges, essentially. So you've got a much more efficient position as long as you stay in range. So if you want to actively manage that, or someone else is going to actively manage that for you, and you can set a tighter range and stay in range, then you're going to have better returns. But that's also like when you're looking at that from a protocol point of view, that becomes very difficult, right? Like for Mars, we need to determine how much liquidity is available in Osmosis pools, so that we can have a certainly or deposit cap, right? Because ultimately what we want to make sure as a lending protocol is that if time comes that we need to liquidate positions, there is enough liquidity in that pool that we can actually liquidate all the positions in Mars. And when you have users kind of just setting their own ranges, like they can be very inaccurate or they can just immediately change over time. So liquidity can potentially dry up very easily with concentrated liquidity. It's actually introduced like a whole new set of problems for lending protocols where AMMs have sort of been, or DEXs have been like on this path to be more capital efficient with LP. But at the same time, that makes it more complicated for money markets to really like justify what the LP liquidity is. So that's like the pro and the con of like concentrated liquidity, passive concentrated liquidity. Like you're probably going to be giving up some of the returns because you might have like a wider spread and you don't have control over setting the tighter range essentially. But you should be more confident that your position will stay in range. And from like a protocol point of view, like Mars, we can be more confident that like as long as the algorithm works, which will be tested over time, and as it's more mature, you can trust it more. We can trust that there'll be liquidity in those pools for us to be able to liquidate.
Ultimately, if you break it down to the basic principles, like active. So if you're an LPer in active concentrated liquidity, there's a minority of those that like actually make quite a bit and do really well, versus the majority. Versus like on PCL, everybody makes the same, and so in average, like if you're LPing. People say it's sophisticated versus non-sophisticated, but it's also like average versus like non-average. Like, so in PCL, you're probably like the average user does, like is going to make more than the average LP on concentrated liquidity. But then again, pros and cons. So from a Mars perspective, like integrating PCL is just like Dane mentioned, from a pure risk perspective, it's just simpler.
One last thing I'll add to that is so that's just like purely from the mechanism design point of view, right? But another thing to consider is like the user experience of like entering an LP pool. So like on Mars, you can enter like this Astroport PCL pool, right? And that becomes more complex when you add a layer of leverage to that. So as a user, you're using the Mars UI and you say, I want to leverage LP now. The essentially like controls that they have to play around with is now like additionally a leverage slider to like enter this pool. And one of the things we thought quite a bit about on Osmosis and their concentrated liquidity is like it's going to be a really complicated UX to enter an Osmosis CL pool on leverage, because you're not only choosing the range, but you're choosing the amount of like leverage to enter into that range. And for that reason, we decided to just like withhold for now from enabling that on the Mars UI. And we're leaning more towards like implementing vaults. The likes of like Apollo, right, is going to be doing some like algorithmic CL vaults essentially, where we can just use that instead and simplify the UX a bit.
So we do have the model to integrate concentrated liquidity pools directly on Mars. We have the model, we can do that. But I would say like it's kind of like adding leverage on leverage, because the thing is, it's like concentrated liquidity itself. You can, when you narrow the range, it's effectively leverage. I mean, it's not traditional leverage, like you're borrowing money to increase your, like, and you owe depth, but it's like you're increasing your risk, right? And potentially amplifying your return or your losses. So it's the same concept of leverage. There's that additional layer of complexity there.
My takeaway of concentrated liquidity in any form is that it's a workaround to the lack of limit orders. Until you have that holy grail on chain, you kind of have to work with these mechanisms.
I would agree that, I've thought about this with Osmosis order book. Like when it comes out, I'm not going to use concentrated liquidity. Maybe there are some use cases, but
why would you if you could have limit orders?
But I think passive concentrated liquidity is a little bit different. Like Astroport is looking to apply their liquidity on top of order books. What it more is, it's actually being an AMM, right? In the sense of it's an automated market maker. So you give Astroport your liquidity and they will actually apply that on the order book for you and essentially allow you to be like a market maker.
You're saying that they are building an order book like implementation on top of their AMM?
So they're not going to build it, but they've been in discussion with like Duality, and I think Osmosis as well, around like taking their liquidity that's sitting in pools and actually like applying that behind the scenes on top of the order book, so that the liquidity actually sits on the order book there. And in that sense, they're just being a market maker, right? Like a market maker would do the same thing. They'd come in and they'd place a bunch of limit orders for like buying and selling in that market. And Astroport would be doing something similar there, where they're applying their passive liquidity and they're actually applying it on top of the order book. So that means that it's like enabling
without user consent.
No, so this is not a feature that's released now, right? But it's something they're looking at building out, and it'll be a new like feature available.
You know what that sounds like to me? You know how when you deposit your money in a bank, it's obviously fractional reserve banking, the bulk of the collateral gets moved to the International Central Securities Depository. Somebody else, like a market maker, is moving the money around and loaning it out, essentially.
That is one way you could look at it. I think that depends on how the user experience is, right? Like if Astroport or whoever is doing this, because it's not just Astroport, right? I think like Elixir is another one that's kind of like taking people's liquidity and then like deploying it all over the place to order books, essentially. So it's more probably about like how they're informing the users of how that capital would be getting used. But I think like the goal is essentially that like when order books come along, there's going to be still a use for like AMMs, and that when people just want a simple swap, they can just go and do that, right? Like I want to swap 10 of this, 10 of this. It's essentially like a market order, but like a simpler UI. And you'll see even like centralized exchanges have this as well, right? Like you can go to the order book page, but they also just have like a simple swap page. When order books become more popular on Osmosis, Neutron, or wherever, people will now have like two options to trade, but that also causes like liquidity fragmentation. So they might not be getting the best price. So I think more the idea is just that, hey, rather than having like two sets of liquidity, let's make sure that they supplement each other. And we can do that by applying the AMM's liquidity on top of the order book. And now we don't have this like liquidity fragmentation. But again, like this is also not my wheelhouse, right? AMMs.
With the natural incentives that come with arbitrageurs arbing on flashbots and skip decrease the liquidity fragmentation because they're incentivized to find the most efficient pricing across these ecosystems.
Arbitraging, as that gets more efficient in Cosmos, it's going to help, but you would still see like if you want to do one big order, right, you just see it just like chew through the order book. So, it might get arbed back after that, but the price impact for that single user doing the big trade would see the damage, I guess.
If it's a true order book, then it just wouldn't get filled, right?
If it's a limit order, yeah, but for a market order, yeah.
Oh, I see. Okay. You guys alluded to vaults. Third-party copy trading vaults are coming in. This is the second time I've heard of a project pushing copy trading vaults. That's interesting. What's going on there? Why is it trending?
Yeah, so I think let's take a step back. The reason why it's a pretty exciting piece of functionality is there's a couple of reasons, right? One is, so if you really look at the user that on Mars, right? There's with the launch of V2 and the launch essentially of the Astroport integrations and the launch of perps, which we'll talk about later, the goal is to attract two types of users, right? One is essentially the speculator, kind of like the person who just like, wants to just take bets, wild bets, like on leverage. So I don't know, I'm bullish Bitcoin, I want to go like 5x, I want to ape in Bitcoin, right? And the other type of user essentially is kind of like a hedger, an investor, right? A person who just wants better risk-adjusted returns, right? Which means lower risk for the same amount of return, or like a higher return for the same amount of risk. When you have like a beautiful ecosystem that uses derivatives and allows like perps and allows you essentially to have, and you have the capital efficiency, for example, that Mars has, which is like the ability to hold any possible collateral in your account. And then you also have the ability of being a money market, which kind of like allows you to hold different collateral than USDC when you're using perps, for example, because then you can essentially your P&L settles in USDC, and then what that means is that like with the money market functionality, you can actually do that, right? When you have these three things, then you can actually be that great marketplace, right, between essentially the speculator, which is just looking for reducing fees, right? So he just wants to trade with the minimum amount of fees possible, and to be able to hold this position, he wants to pay the minimum amount of fees possible, right? That's the funding rate, right? And on the other side of that trade, essentially, is the hedger, the guy who wants to reduce risk. Given that, these copy trading vaults are exciting for both users. Basically, if I am a guy that has capital and I don't know how to trade, and there's people that do, I can actually ape into vaults where they're essentially where these guys are trading and they're accepting capital from other people, right? Akin like ETFs and funds and whatnot, right? And we've seen success of that, for example, in Hyperliquid. They have these perps trading vaults, and they have attracted quite a bit of TVL, and they're very successful, right? So that's attractive. But on the other side, for people like me that are not wild traders, I'm just looking for the best possible way to park my money and get good returns, right? And minimal risk. So when you have essentially the capital efficiency of Mars, you get into all these like sorts of complex delta neutral strategies that you can do, One very simple one, which is not that complex, but Athena made it famous, right? Is a basis trade. That's going to be possible on Mars with with basically 2 clicks, right? To do if you want to do it by yourself. But many people don't want to do it themselves. Then how do you allocate between different markets? Maybe you want to use leverage on that. How do you do that? There are going to be several interesting investment opportunities in Mars, and many people are not going to be able to do that, or are not going to want to do that manually. And these copy trading vaults essentially allow people to just ape in these strategies, and with pretty stable yield, right? So it's essentially it's catering to both type of users, and it's exciting on Mars, and it makes sense to build on Mars because the credit account itself is composable, so it's really easy. They can talk about the tech in a second. It's really easy, basically, to sort of like build this on top of Mars. It's its own thing, and it's got a use case that's attractive, not just the Cosmos users, but ideally from users coming from outside as well.
You mentioned Athena. Can you expound on that?
So Athena basically is this. It's a big thing of the cycle. In my opinion, it was one of the biggest things in the cycle, besides the meme coins, where essentially what they're doing, they're kind of like democratizing in a way like basis trade, which is this thing where a lot of arb traders, what they do is, if you have the ability to hold essentially the spot asset, for example, Bitcoin, right, BTC, right, in an account, and then for the same size, right, of that, you go short the perp, right? So what happens there is so I hold, I don't know, 1 Bitcoin, and I go short a perp of 1 Bitcoin size, right? So what that does, it creates this synthetic stable coin, where essentially this stable asset, where essentially, because if the spot asset goes up in price, the perp will lose money, right? If the spot asset goes down in price, the perp will make money, right? So you essentially have this kind of synthetic dollar, let's call it like that, where it doesn't really move, right? It's stable one against the dollar, right? On top of that, though, it has a positive yield. What does it have a positive yield? Because historically, funding rates, which is kind of like what the mechanism that perps uses to balance open interest in markets, right? So the funding rate essentially has been positive, which means that if you go short the perp, you get paid for that, right? Because there's more longs, there's more people interested speculating and going long and making bets on prices going up than people speculative going short, for most of the time, of course, right? So that given that, historically, it's been between 20 and 30% yearly, spikes up, goes way up during bull cycles. But the point is they built this synthetic stable coin, USD, that if you hold it, it doesn't move in price. And then if you stake it, you essentially get this funding rate on top of that. So it's you're getting a stable yield. But the thing with Athena is that it's not a pure DeFi play. It's very centralized, for a reason being that a lot of the volume of perps is not in DeFi right now. It's in centralized exchanges. So for them to build this stable coin at scale, they really, at this point in time, they really need a way to use that, right? And so that you need
so is what's happening that they're when a user deposits into Athena, it's basically depositing into an Athena controlled wallet or multi-sig, and then they go ahead and create the perp for you on some centralized exchange?
Yeah, in the simplest form, what we're doing essentially, if you're depositing Athena, USDC, what they're doing is I think it's going to a multi-sig. I don't know the sort of I don't know really the mechanics behind it, the details.
Well, yeah, you're depositing to Athena Corporation or Labs or whatever.
Yeah. And so what they're doing, they're swapping that for a part of that for SDETH, or the LSD of ETH, so they can get the yield on top of that. And then what they're doing, they're taking essentially the stable coin and essentially depositing it into their partners, which is Binance and these guys. And then they're going short the perp, basically, right? That's what they're doing. And then they have this mechanism of rebalancing it to make sure that they don't get liquidated, essentially, in these exchanges.
Where does Mars come in? It sounds like you guys are building something similar. Is the infrastructure different? Is it all on chain, or is there a centralized component?
We're not building something similar, but what we're doing, we're offering this. So this basis trade the Athena adds the component of the synthetic stable coin on top, right? We're not doing that. We're not building a synthetic stable coin. It doesn't make sense right now in DeFi. If you look at the total open interest in DeFi right now, it's in the hundreds of millions total. To do something like this, you need billions of dollars of open interest, right? So that's why you need centralized exchanges. We're not doing that. That's not our goal, at least not right now. What we're doing is with the credit account, you can actually do this basis trade yourself manually in Mars, and it's really simple to do. It's way less complex than Athena's doing it. And it essentially it's happening all in the Mars credit account, right? So Mars perps, what I can do, literally I can deposit WSD, for example, 10 WSD, and then I can go short 10 WSD with that collateral in my same credit account, cross-collateralized and cross-margined on Mars with Mars perps, right? And what I'm doing is that myself, I'm collecting that funding rate. That's kind of like what you will be able to do on Mars if you want to. The copy trading vaults allows people that don't know how to do that or don't want to do that to essentially get access to that type of like stable return, really good risk-adjusted return, without having to worry about the mechanics and the operational aspect of it.
And when you say minimal risks, what are the risks, however minimal?
Yeah, they say minimal risk, lower risk,
yeah,
better risk-adjusted returns. Yeah,
I mean lower risk compared to what?
This is just like talking about financial risk. It's just saying it's just more relative to volatility, to prices, right? That's what I'm referring to.
It's riskier than just holding spot in your wallet.
It depends how you measure risk, right? So if you measure risk as price risk, then it is less risky, right? Because if I'm holding Bitcoin,
because you're doing a delta neutral. Price risk aside, what other risks are there to doing that?
A ton of risks. So
nice.
So yeah. So I mean, so of course there's all the risks that you have with anything that you do on chain on a DeFi protocol, like like the sort of the infrastructure risk, the protocol itself can
smart
have
contract.
Yeah, smart contract risk. You can have bugs. Money markets are notorious number one place where attackers. Yeah, just like there's
they could drain the smart contract that's custodying all the tokens.
Yeah, well, so there's smart contract risk in the way you're handling things. You can have bugs where essentially they can just kind of like take, they can attack you in different ways. But like there's really most money markets, the way they get attacked is because the risk logic that they have has some hole in it, right? For example, like Mango markets, right? The attack there is not really the smart contract. It's not like it's
an economic attack, yeah.
Exactly.
Plus flash lens.
Yeah. So like that's one mechanism that people use to find, but that the flash loan itself is not the issue. Is like that's just like a tool of how you make that attack.
But you also can't prevent flash loans from existing. So
you can't. I mean, you actually can do similar things as flash loans on Mars today on Osmosis, right? So that's how liquidators liquidate. But I guess what I'm saying is like, yeah, smart contract risk. You have protocol. You have money market protocol, like how you're managing risk, right? Are your risk parameters right? You have the perps. The way we're building perps, essentially, we use a P&L vault. So you have counterparty risk if you're depositing, in the vault. The way we're building perps is Oracle-based perps.
There's Oracle risk too, right? If it's grabbing the wrong price, it could potentially cause some kind of liquidation.
Yeah, I mean, I can let Dane talk about the Oracle risk.
As you say, like smart contract risk, more like economic attack risk, which is probably the most likely. Liquidity is always changing within the ecosystem, but with most money markets, including Mars right now, like the risk parameters are like static. So like they need to be constantly adjusted to meet the liquidity in the ecosystem, right? And when there's a disparity there, like often that can open up an economic attack. Oracle risk is also a viable thing. You can build in circuit breakers around the oracles for things like a bad price feed where you don't liquidate everyone. That's one path you can take, and Mars already has that for its current lending protocol. There's also a bunch of risks around like bad price sources and front running and whatnot, and Mars is like really excited to be using Slinky, which is
the skip
going to be essentially like the best oracle on offer in DeFi as far as technically how they're posting things on chain, right? Like there's two sides of Oracle. There's like quality of price sources, which I would say people like Peth are very good at. Their price sources in general are very varying from different sources, including like market makers and that. So they do a really good job there. But the downside of that is like this pool-based Oracle where you need to yourself like grab the Oracle price from off-chain and try and push it on-chain with the transaction. And that can be an attack vector, both in like there being a stale Oracle price, but also in people being able to essentially like clog up the chain and not allow you to post Oracle price updates on chain. So there are like two risks, and that's where Slinky kind of avoids those, right? Like they can guarantee that every block there'll be a price update, which is really awesome.
The Oracle risk, yet another risk that could be mitigated with limit order books.
It depends, right? Like perps protocols, even order book perps protocols also need Oracle prices, but purely like spot order books.
Lastly, let's cover the new tokenomics, since obviously if the infrastructure is changing so radically and the Mars hub itself is being deprecated, what can people use the token for? And given the new money market, are there, I mean, I'm assuming there's probably going to be incentives for bootstrapping your usage, right?
Are there going to be incentives to bootstrap usage?
Given all the risks, there's probably a carrot.
Yeah, the carrot is like the product, like okay. So if we attract users because because of just like, throwing them like our governance token or stuff like that. It's just like not a sustainable way, right? So we really want to attract users because we want to offer them the best possible avenue to trade and the best possible avenue to get like better risk adjusted returns. With that said, there's things happening with not necessarily with us our direct incentives, but things happening with other things that are being launched on Neutron that might be quite attractive, right? Mars, you're going to be essentially able to do things on leverage on Mars, and then which will allow you to amplify, right? If other protocols are dropping incentives, like you'll be able to amplify those through Mars.
Is it true that whatever new tokens launching on Neutron, they could possibly open up a money market on Mars and create incentives there themselves?
Yeah, I don't know how much I can say because it hasn't been publicly announced yet. So there's something I can't talk about, but you could probably
infer.
Yeah, you can infer what it is. To speak about incentives, we're probably going to have some incentives when we launch perps. And there's a couple of incentives we'll have. Like one is we're launching a public testnet that's going to be incentivized, and it's going to be incentivized in a cool way. It's not just going to be like these testnets. You just go in, you do an action, you get some Mars. No, not like that, right? It's more like you come in. Of course, you get Mars if you are able to, like, as a bug bounty thing, right? If you're able to find bugs, but you'd also get Mars. We want to create like a trading competition where essentially we want to really incentivize people to go in and go crazy on leverage, just go all in, do crazy shit, like so we want to incentivize people to. So we'll probably give Mars to the person who makes the most, who has at the end of the public testnet has the highest P&L. The person
drained your wallet.
Yeah, the person that got wrecked the most, the person that got liquidated the most, so you literally lost the most. We're coming up with a formula that makes it cool and interesting. And the intent is go as crazy as possible, use it in the heaviest possible way, really stress test it. And another thing that we're doing is, the way our perps works is Oracle-based perps. And we have, like, unlike Levana, that they have essentially, they're fully funded, which means, like they actually lend LP positions. So you come in Levana, you deposit like some collateral into an LP, and then they lend that out to the perp trader, right? Kind of like GMX did and invented that style. We're not like that. We're going to be essentially P&L vault. We're going to have like a one stable vault, which is the counterparty of all trades. It means like we're not renting out, exposure, right? It's more like we have risk parameters on open interest. So clearly it's important that we have deposits into the vault. So we're going to be probably incentivizing that with some Mars so that we attract deposits in there. The whole tokenomics revamp is probably something, I don't know, David, do you want to talk about that? It's kind of like something that we just recently voted on, chain, it passed, and we're in the process of implementing, and that's going to be quite exciting, I think.
Sure. I'd add some thoughts on just in general, like the incentivization stuff as well. Like the goal is to actually build a product that has product market fit for us right now, right? And we believe like what we're building is coming together into like a very unique offering that enables like capital efficiency, unlike anywhere else in DeFi right now, I would say, but definitely within Cosmos. So, being able to do all of the actions that you can do in Mars, like spot trading, margin trading, perps, LPing, and using any of these things as collateral to do something else on it, really enables like quite a creative like design space where you can use LPs as collateral to do perps. You can do some points farming potentially, and then you have these like vaults built on top of it, so that if there's like this new hot thing and you don't know exactly how to do it, there's this whole social side introduced where CT influencers or KOLs can specialize in that and also make money on it by having a performance fee on these vaults. So like there's quite a unique offering, and we've been building this out for years, and the team really feels like this is all coming together. And perps and copy trading, it kind of like the two final pieces, and it's not that we'll be done. We'll continue enhancing those, but once we get to that point, it's going to be such a creative protocol and product you can use that the usage will just organically grow as a result of that. On the tokenomics side of things, there's like a number of things that we're looking at. We've been ignoring tokenomics like since Terra. We really have just been wanting to focus on building this awesome product, and we're almost there for first version of like every major piece of functionality that we want. So we do want to turn some focus to tokenomics. I think the big one, because a lot of people were saying, like, how is tokenomics going to help the price, etc., talking about all this. But for us, the big thing is finding that product market fit where we can have a decent amount of protocol revenue coming in and doing Mars buybacks, right? And kind of like what we pointed out earlier, being a money market in Cosmos right now is just not very attractive. I'm not sure if Mars has got the most TVL right now out of all money markets in Cosmos, but it's up there, right? Like no one is order of magnitude larger in TVL, and the kind of revenue that you can get right now off just being a money market is not enough to have a good buy pressure on a token. Whereas with this new product we're launching around perps and copy trading and the usage we see there, that the protocol revenue is going to like increase dramatically. And that is going to mean that when we switch to buy and burn of the Mars token, we should be burning a lot of Mars essentially. Like, so that, I think that is the most important takeaway for tokenomics, right? Is like a more sustainable tokenomics move where we're burning a bunch of Mars because we now have a product that we think is going to have product market fit, and we're excited to use it ourselves. So that's a good sign, right? Like a lot of people are excited about it, but we've also done a bunch of other things around tokenomics. Like we've got a really big community pool. So we decided that we're just going to burn, well, we suggested that we should burn 300 million of that initially. There are two things that we kind of hear about from potential like investors in the token. And one is that like the FDV is too high and it scares them away because there's all this token floating out there that could become circulating at some point. And the other issue is like a lack of liquidity, right? So like right now, if you want to go and buy, I don't know, like 20 to 50K worth of Mars, the price will probably double because there's just not a hell of a lot of liquidity. So those are two things initially that we want to solve around reducing the FDV and increasing liquidity. And we're working on some POL deals to increase that initially. Longer term with the protocol revenue, we also want to start directing some of the protocol revenue into like buy and LP. So the protocol would end up actually increasing like the LP liquidity amount available there as another way to like more sustainably enable like larger liquidity for people buying. Those are the main things initially. Kind of looking at and still kind of brainstorming, but looking at like the best use cases for the Mars token. Immediately, like the obvious one is that we can have some fee discounts on perps trading because that can be one of the more expensive things around perps trading. And this is particularly interesting for people building vaults that would utilize perps. You have someone like Apollo, for example, they might want to come and build this kind of like Athena-like basis trade vault. But if you're going to be constantly adjusting your perps positions, you're going to be eating through trading fees. That would be then potentially very attractive for them to actually go and stake a bunch of Mars, and they will have like a much reduced fee for trading perps. From there, it's, you know, we can get a bit more creative as well, but that's essentially what we're looking at. We want to align people that want to stake Mars and also use the platform.
Another natural use case there is, or for the token, for utility of the token, is these yield opportunities that we talked about. Many of them are going to be capped, just the way we manage risk, right? I mean, I'm sure you heard Osmosis complain a lot about our caps. We do have to have caps, right? Because it's one of the best risk controls around all different type of attacks, right? And so we will have caps, of course. What happens is like a lot of these yield opportunities are going to be capped by the caps. You might have some yield opportunities that are like 75%, right? With delta neutral, something like that, APR, right? Which sounds crazy, but it's not crazy if it's capped, basically, because it's crazy if it's unlimited, kind of like Terra, right? You just deposit it, it will keep growing. Here it's capped, right? So what will happen is like, you know, what we could do to give utility to a token is like, if you stake token in proportion to how much you staked, you know, you can get access, preferential access, and get some allocation of this strategy. That's another good, I think, use case.
That would be a great use case if, as a Mars holder and staker, I somehow want to accumulate it because it gives me more share of the funding rate revenue in any given vault.
Yeah, or just simply like to get access to this type of strategy, like, you know, we call them, for example, high leverage strategies, where you can go up 7x, 10x in leverage in the special credit accounts. To get access to that, you know, like you need to stake, I don't know, this amount of Mars, right? And then you'll be guaranteed up to, I don't know, like 100K that you can put in, right? Something like that, right? I'm just thinking out loud. It's a way to price scarcity.
Definitely. Wow. So great. Thank you both for coming on the podcast. Are there dates that you want people to watch out for? How can people follow the updates? How can people follow you?
Mid-July-ish is going to be exciting. There's going to be some product launches. Mars V2 on Neutron is going to be launching around then with some new functionality compared to Osmosis. And there are some other protocol announcements coming up within the Neutron ecosystem. So I would watch out for sort of the second half of July there. And then the big launch for us is going to be Perps. We've been building this out for a long time. And yeah, I can't give a date right now. The devs won't be happy with me, but Q3 24 roughly is what we're aiming for there.
In the meantime, are there things that users can do today to start farming potential points or yield farming opportunities now?
Watch out for some news in the next couple of weeks, because there's some unannounced stuff that is coming up there around the Neutron ecosystem. That'll be exciting, and we should see a lot of hype around that, hopefully. Another thing on the Osmosis side is we don't enable leveraged sort of LPing into the concentrated liquidity pools, but we have been working with Osmosis. Essentially, they're building out some vaults that sit on top of concentrated liquidity and tokenize it. So we would be looking to implement them soon, but not quite yet. Hang tight for that announcement also.
Great. Sounds good. Where can people find you?
Twitter. So Twitter. Dan Cree is my Twitter handle, as you can see on my name there.
I should change mine. Mine is Doko_01.
You're Doko_01. Nice. I didn't know you were V1 of Dokwan.
No, Dokwan. Please.
Oh.
Doko, DOHKO. It's a Japanese name. _01. Yeah.
Okay. Doko _01. Doko. Okay. Yeah. All right. Cool.
Yeah, I follow you.
Nice. All right. Well, thank you guys for coming on the show, and congratulations for your soon-to-be launch of your public testnet. And I look forward to trying out some of your vaults and perps products and losing money on them.
No, you're just gonna make money. So that's.
I hope so.
Bye.
See you guys.